What if the most important financial story of your lifetime is unfolding right now, and almost no one is covering it? What if the number being whispered in vault rooms across New Jersey is the kind of number that ends the way paper money has controlled everything? What if the trucks backing up to those warehouses are not moving product? They are moving history. Something changed inside the world's largest silver exchange. Not gradually, not symbolically. In real, physical, irreversible terms. The kind that cannot be undone with a press release or a policy shift. And the silence surrounding it, from the financial media that is supposed to inform you, is itself a story worth examining with the full weight of serious concern. Here is what we know. We know that in the first 4 trading days of December 2025 alone, over 47.6 million ounces of silver were claimed for delivery, representing more than 60% of COMEX's total registered silver inventory, an unprecedented depletion rate by any historical measure. We know that in a single calendar year, the full year of 2025 combined settled 474 million ounces of physical silver against 203 million the year before. The number more than doubled in a single calendar year, without a headline event most people could name. And we know that for 15 consecutive months through early 2026, physical silver has been leaving COMEX warehouses at volumes the exchange has never processed. You do not need a graduate degree in finance to understand what that means. You need only ask the question every serious observer should be asking. If this many people are demanding the physical metal itself, rather than simply trading a piece of paper that represents it, what do they know? What are they running from? And what does it tell you that the mainstream financial conversation is almost entirely focused elsewhere? Pay close attention to what follows, because when we understand how these numbers were built, we begin to understand why they are so difficult to reverse, and why that matters enormously for ordinary people trying to protect what they have earned. The system in question, the COMEX Futures Exchange, is not a market for silver in the traditional sense of that word. It is a market for paper promises about silver. For decades, most participants were content to trade those promises back and forth without ever demanding the metal beneath. The beauty of the arrangement, from the perspective of those managing the system, was that the number of paper contracts could vastly exceed the number of physical bars available. A contract is just a document. A bar weighs 1,000 ounces. The leverage this created was enormous, and it turns out fragile, in ways that only become visible when the arrangement begins to unwind. The unwinding has been happening. Paper leverage is currently elevated at 5.7 times, meaning there are significantly more paper claims than deliverable metal. At the same time, the silver market has been experiencing backwardation, a condition where the spot price sits above the futures price, which often signals strong immediate demand or a supply shortage in the current physical market. These two conditions together, too many paper claims and immediate demand outrunning future supply, are the financial equivalent of a structure showing cracks in its foundation. The question is not whether the structure will shift. The question is how far and how fast. And there is still so much more to this story that we have not yet touched. Stay with us. The January 2026 delivery figure, 49.4 million ounces, more than 7 times what January 2024 had generated, is the kind of number that deserves contemplation rather than casual mention. 7 times. In a single year. For a commodity that changes slowly in an exchange that has existed for generations. That is not an aberration, that is a signal. And the people arranging the trucks, the insurance, and the transport of all that metal are not doing so on a whim or passing sentiment. They are making a durable, costly, deliberate choice to hold real silver rather than a ledger entry that promises silver. The question worth asking, and the one that mainstream commentary has been curiously reluctant to pose, is why they are making that choice right now, in these specific months, at this specific pace. The Sprott Physical Silver Trust doubled its capital raise program in January 2026 to $2 billion, enough at then current prices to buy approximately 18 million ounces of physical silver, representing roughly 16% of COMEX registered inventory in a single institutional move. Sprott is not in the business of manufacturing anything. They are in the business of holding real silver on behalf of people who want real silver. When an institution that size moves with that kind of urgency, observers of markets and institutions have learned across decades of observation that it is worth paying very careful attention. The deeper story is not about one institution or 1 month. It is about what happens when a system built on the assumption that most participants will never demand physical delivery begins to encounter participants who insist on doing exactly that. The assumptions crumble quietly at first, then at a pace that surprises nearly everyone, they crumble loudly. History has a name for those moments. It calls them turning points, and recognizing them requires looking past the daily price chart and into the vaults, because that is where the real story has been written. If you have stayed this far, you already understand something that the casual observer does not. You understand that what is happening on the surface of the silver market, the daily price movements, the commentary about Federal Reserve policy, the cheerful reassurances that everything is functioning normally, is not the whole story. Not even close. But what you may not yet fully appreciate is that the vault drain at COMEX is only one thread in a much larger and more consequential tapestry. Pull on that thread, and what unravels is a picture of a global strategic realignment that has been quietly building for years. Before we go any further, if this channel has helped you see what the mainstream isn't showing you, take 5 seconds right now and hit that subscribe button. Because the next few updates we're preparing may be the most important ones we've ever released. Don't let the algorithm decide whether you see them. That choice belongs to you. Now, the thread. On the first day of January 2026, the People's Republic of China implemented something that received remarkably little attention in Western financial media, given its significance. China officially reclassified silver from an ordinary commodity to a strategic material, placing it in the same category as rare earths. From that date, silver exports require government licenses, granted only to 44 approved firms, and these firms must meet strict criteria: annual refined output of at least 80 tons, credit lines above $30 million, plus scrutiny at the national level. This is not a bureaucratic adjustment. This is a geopolitical declaration. China is one of the world's largest producers of silver, and in the first 11 months of 2025, it exported more than 4,600 tons of the metal. Then it stopped. Or rather, it reduced to a controlled trickle what had previously been a flood. The country that had been a significant net exporter of refined silver abruptly stopped. The same move it made with rare earths, with tungsten, with antimony, identifying a material essential to the next economy, and pulling it behind a licensing wall before anyone in the West had fully understood the implications. Elon Musk, notably, saw this clearly. When the restrictions were announced, he responded publicly, "This is not good. Silver is needed in many industrial processes." What Musk did not say, but what the data strongly implies, is that the need goes far beyond industry. Silver is now a strategic lever, and China has placed its hand on that lever with the quiet deliberateness of a nation that has been thinking about this moment for a long time. The accumulation context is staggering. Analysts estimate that China's actual gold purchases in 2025 may have exceeded official figures by as much as 223 tons, suggesting a more aggressive de-dollarization trajectory than publicly acknowledged. As of 2024, China held approximately 70,000 metric tons of silver reserves, with strategic purchases continuing into 2026. Now, these are not the actions of a nation that views silver as a minor industrial input. These are the actions of a nation building a foundation, a monetary foundation, that exists entirely outside the reach of Western financial sanctions and dollar-denominated settlement systems. China's motivations extend beyond simple resource conservation into broader geopolitical strategy. The export licensing framework enables graduated escalation from reduced quotas to complete export prohibitions, depending on geopolitical circumstances. This is the language of leverage, written not in diplomatic communiques but in export permits and vault inventories. The West has been slow to recognize it, in part because the dominant mental model in Western financial institutions still treats silver primarily as an industrial commodity. That model is becoming obsolete. Industry estimates suggest cumulative shortfalls in silver of roughly 820 million ounces between 2021 and 2025, nearly equivalent to a full year of mine production. A fifth straight year of structural supply deficits, with the cumulative shortfall from 2021 through 2025 approaching 820 million ounces. Now China has withdrawn the supply that had been helping paper over those deficits. From 2026 onward, the structural shortages that were previously papered over by drawing down above-ground inventories are evolving into an overt supply crisis that can no longer be masked. The physical reality of silver production makes this worse, not better. Mine production has remained stagnant, actually declining from 1.07 billion ounces in 2010 to roughly 1.03 billion ounces in 2024-2025. A key constraint is that most silver is produced as a byproduct of gold, copper, lead, and zinc mining, meaning supply is relatively unresponsive to silver price increases. Miners cannot simply ramp up silver production when prices rise. The mine does not change its geology because the market changes its mind. Silver comes out of the ground at the pace the earth permits, not at the pace the balance sheet demands. And now consider what sits on the demand side of that equation. Industrial demand accounted for approximately 59% of total global silver consumption, with green energy applications representing the fastest growing segment. Solar panels, electric vehicles. The AI infrastructure build-out, server farms and data centers running on components that require silver in quantities the industry has not fully grappled with. The United States added silver to its critical minerals list, citing the precious metal's important role in manufacturing advanced energy and defense technologies. Two of the world's largest economies have now officially declared silver strategic. The market has not yet fully priced what that means. The price trajectory tells part of the story. Silver entered 2025 at roughly $30 per ounce and surged to about $70 per troy ounce by late December, more than doubling in value over the course of the year. The precious metal achieved its current all-time high of $109.21.62 in late January 2026. Silver surged to record highs above $70 an ounce, comfortably outperforming gold, driven by a perfect storm of macro conditions, market structure stress, and real-world supply constraints. But the price is not the story. The price is the symptom. The story is the structural shift underneath, and that shift has not finished announcing itself. There's a pattern in history, patient, recurring, and maddeningly consistent, in which the most consequential financial shifts are the ones that proceed most quietly in their early stages. The people who recognized them early were rarely celebrated for their foresight in real time. They were, more often, dismissed or ignored until the shift became undeniable. Then, and only then, did the consensus catch up with what the patient observer had seen all along. We are, by any serious reading of the available evidence, in one of those moments. Let us situate this moment in its proper historical and economic context. The World Bank's April 2026 commodity. Markets Outlook projects that its precious metals price index will surge 42% in 2026 relative to 2025 averages, making precious metals the top performing commodity class of the year, ahead of energy, base metals, and agricultural goods. Four drivers underpin that forecast: the Middle East, conflict disrupting energy supply, a resulting global inflation surge, stagflation risk as growth slows while prices rise, and accelerating safe haven demand from central banks and retail investors rotating out of conventional assets. The word stagflation deserves more than a passing mention here. It is an ugly portmanteau for an uglier reality: simultaneous inflation and economic stagnation, a combination that confounds central bank policy and devastates conventional portfolios. It is precisely the condition in which historical data, real, documented, verifiable historical data, shows precious metals performing with exceptional strength. In a stagflation scenario where inflation is dominant, but the economy avoids severe contraction, silver's industrial demand base supports prices from below, while monetary demand pushes from above, creating the conditions for exceptional performance. The precedent the 1970s provides is instructive, but, if anything, understates today's structural intensity. The debt levels that define this moment are categorically different from those of any previous stagflation episode. Ballooning deficits and mounting debt servicing costs have contributed to a U.S. dollar that experienced its steepest annual decline since 2017. In the United States, inflation hit 3.8% in April 2026, the highest since May 2023, and nearly double the Federal Reserve's 2% target, leaving the Fed boxed in. Cut rates to support growth and you add fuel to inflation. Hold rates and you risk tipping the economy into recession. There's no clean exit from that box. There's only the management of competing pressures and the hope that the structure holds while adjustments are made. Gold and silver in this environment do not benefit from hope. They benefit from the absence of it. Central banks around the world have drawn the same conclusion, and they are not waiting for consensus. Central bank demand has been accelerating as a consistent structural factor. Turkey uses gold to stabilize currency volatility. Russia leans on gold as a sanction-resistant asset. And India, along with several Middle Eastern economies, see gold as long-term diversification rather than a short-term hedge. These are not reactive purchases. They are deliberate repositioning, the kind of institutional decision that unfolds over years, not quarters, and that reflects a judgment about the durability of the existing monetary order. Chinese gold ETFs saw a 243% surge in assets under management in 2025, underscoring the trend. The gold-silver ratio, that ancient measure of the relative value of the two metals, tells a story that should arrest the attention of any serious student of monetary history. The current ratio of approximately 60 to 70 to 1 remains dramatically elevated relative to the historical monetary ratios of 15 to 20 to 1 that prevailed when both metals functioned as monetary instruments. Compression of this ratio toward monetary norms, even partially, implies silver price appreciation that would substantially outpace gold's percentage gains from current price levels. The precious metals complex enters this period following 2025, in which gold traded above $4,000 per ounce and silver surpassed $60 per ounce, thereby establishing new all-time highs for both metals. Major financial institutions have consistently upgraded price targets as macro drivers intensify. Goldman Sachs projects gold reaching $4,900 per ounce by December 2026. Citi has issued a target of $110 for silver in the second half of 2026. citing acute shortage of physical silver available for immediate industrial delivery. Now consider what has not yet happened and what that implies. The vast majority of ordinary investors have not repositioned. The mainstream conversation is still largely absorbed by interest rate speculation and equity market fluctuations. Mining companies, as one financial commentator observed, still convert virtually all of their earnings into paper currency reserves rather than holding a portion of their treasury in the very metal they produce. An irony that, if it begins to resolve, could add yet another layer of structural demand to an already strained physical market. The institutional rotation is still in its early phases. The retail recognition has barely begun. In terms of metal leaving the vaults, the exit continues in what analysts describe as a very slow but deliberate fashion, as if someone is extracting metal from COMEX in a very organized way to avoid pushing the price back up prematurely. Whoever is accumulating wants to see prices stay contained for now. That sentence, if you read it carefully, is extraordinary. The accumulation is organized. It is deliberate. It is designed not to announce itself. And yet the vault records, available to anyone with the patience to read them, announce it anyway. So, before you leave today, drop your thoughts in the comments below. Do you believe the paper silver market can survive the kind of sustained physical drain we have just described? Or do you think we are watching, in real time, the early stages of a repricing that will define the next decade? Your perspective matters here, and so does the perspective of everyone else in this community. The comments section is where the real conversation happens. And right now, this conversation may be the most important one in personal finance. The signals across geopolitics, market structure, historical precedent, and global institutional behavior are pointing in the same direction. Not unanimously. Nothing in markets is unanimous. Not with certainty. Nothing in markets offers certainty. But with a coherence and a consistency that serious observers cannot dismiss without a very good reason and without an alternative explanation that accounts for all of the evidence before us. History rarely announces its turning points in advance. It leaves clues. Right now, the clues are abundant, specific, and for those paying attention, unmistakable. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.